See, I told you, I freeze up. I don't know what to do. All right. Well, my name is Collier. I happen to be the founder of the Lachlan Group, local real estate firm here in Battleground. If you see a dog in the photos or the videos, that's Tucker. He's our director of Floofonomics. And our guest today is Duke with Summit Mortgage. And Duke, why don't you introduce yourself?
My name's Duke Clinton. I work for Summit Mortgage. I've been in the mortgage business this is going on my 8th year. I'm licensed in Idaho, Washington, and Oregon. I'm originally from Idaho, moved over here with my family about 15 years ago, so I'm almost to the level where I could call myself a local. Prior to that, I worked in engineering for a lot of years, so I've got a good background on the mathematics portion of it. I've worked with Collier maybe going on 4 years now?
4 or 5.
4 or 5.
Yeah.
If I say 4, it's been 5, right?
Sure.
And I'm happy to be here. I appreciate him giving me the offer and sit down with him and talk about some mortgages and real estate.
If you can't tell by the decor, it's Christmas season. We're going to cover a few different topics today, but to get started, we should probably take a look at some of the things that are kind of trending right now, which would be the 50-year mortgage.
I get a lot of questions on the 50-year mortgage. When are we going to do it? Are we doing it? What's a 50-year mortgage look like?
I was going to say, I didn't even know there was 50-year mortgages until I heard it on the TikTok or something. I was like, what the hell?
I don't know right now, at least at Summit, we don't do 50-year. The most we could do is 30. I've heard that there are potentially companies out there doing 40s, but I've not got any evidence of that. But a 50-year is something that nobody does right now. I think some other countries you talked about, you've done some research that will do a 50-year, but I know it's not something that's happened a lot in the United States right now.
Yeah, so one of the things that's kind of happening is, our current administration mentioned like implementing a 50-year mortgage. And like most people, I go, what is a 50-year mortgage? I'm like, it makes sense, 50 years for a mortgage. I get it. I have a 30-year, right? So yeah. I get what it is, but like, it just seems like so long, right?
50 years is a long time.
We give a 1-year-old a mortgage, he pays it off when he's 50. Like, what the hell, right?
On average, people are only in a mortgage, even though everybody gets you can do a 10, 15, 20, 30. We can really do any amount of time in between there, but those kind of the normal kind of cutoffs for every kind of a 5-year is what somebody would look at. A 50 is getting out there a long, long time, but somebody only sits in a house for 5 to 8 years is kind of the average that somebody owns a home. So even if we go out 50 years, it's pretty rare. Like my mom and dad, my grandparents stayed in their home for 30 some years and went through a mortgage, right? The same mortgage. Maybe they refinanced a few times, but they did a 30-year mortgage. You just don't see that very often anymore. People tend to be more mobile nowadays than I think they have been in the past, right?
Yeah, no, my wife and I plan on never moving. So
yeah, that's rare.
But it's only the plan, doesn't mean it's going to happen, right? And we've refied at least once since we bought our house because rates went down to make it to where it was, at least in our minds, it made sense, right? No, I did do a little bit of research, obviously. 50-year mortgages are basically in almost every country around the world except for America. So, apparently you can go to Canada, Mexico, Germany, you can get a 50-year mortgage. Now, from what I could tell, some of those countries, the 50-year mortgage only somewhere around 23% of all mortgages. So even though it's available, it's not the most popular. The standard 30 seems to be your most popular mortgage that everybody gets. So it's why would we be talking about bringing a 50-year mortgage when we already have a 30? And people are saying it's housing affordability. We're going to make it less expensive for people to buy a home. On the surface, that sounds like some good pros, right? You're going to be able to get a slightly lower payment because you're just extending the length 20 years. But, the there's got to be some cons or negatives to it, right? Like, so since you do loans, like, do you think it would look different than a 30-year mortgage? Or,
Well,
I mean, what?
Like you said, you're going to get a slightly lower payment. You're going to spread the time that you paid out over, so that's how you're going to reduce the payment. Some of the cons are, as you spread that payment out, if you amortize, which just means what your payment look like over the length of the loan, right?
Mm-hmm.
And your first payment, just kind of generally on a 30-year, you're going to pay maybe 30 to 40% of the principal, and the rest is going to be interest. That's your first payment.
Yeah.
And at the end of 30 years, it's going to be the reverse of that. The last
Mm-hmm.
payment's going to be, the majority is going to be principal, and the minority portion of it is going to be for interest. And so on a 50-year, that's on steroids, right?
Right.
You're going to be paying 20% of the principal and 80% of the interest. So your payments are going to be not as effective as knocking down that principal. So your ability to accrue wealth is going to be delayed because you're paying interest the whole time and you're not paying off your loan. So if you're in a 30-year, after 10 years, you've paid off a fairly good portion of the principal, right? You've knocked it down quite a bit because you're paying more. On a 50, you're not going to be in that same position. So it's really going to hold off how much you're going to be making on the house because you're paying interest the whole time. You're not paying down your principal. So that's one of the things that is kind of a negative of the 50-year loan. It just not paid off nearly as fast.
So kind of basically, it's like when I have clients, first-time home buyers. They're usually, younger than I am. They're buying their first home. And I tell them, look, if you can do it, stay in this home 5 to 7 years. Because based on you paying your mortgage and the rate of growth in the market, at 5 to 7 years, you might have enough equity to sell, upgrade, or do whatever you need. And I say might because markets are different, scenarios are different. It's not a guarantee, but like at least 5 to 7 years, with the right growth and the right pay down, you should be able to sell and not lose money, right?
Correct.
So what I think you're saying is on a 50-year mortgage, that growth rate is going to just take a lot longer. So what, people got to stay 15 years before they can see a significant increase how is that going to work?
So, if you look at how much a house increases in value, average, if you went 5 years ago and looked at it, it's crazy, right? Their 1 year was 25% homes were increasing.
Right, yeah. That's never going to happen again, I hope.
That's probably not going to happen in the next 50 years.
Yeah.
They average around 5%. So when you're talking about the 5 to 7 years, 5 times 5 is 25. You've roughly got 25%, equity.
Plus you've paid down a little, so you got a little bit more there. Side.
So you got enough usually to sell that house and do a 20% down payment on your next house if you're a first-time home buyer.
Exactly.
So if you're a first-time home buyer, it's minimum out of pocket. Let's just get into a house and let's that house increase in value and use that as our stepping stone for the next house.
Right, which is exactly what my wife and I did. We were able to do an FHA loan. We put 3.5% down.
Yep.
We bought a house. 6 years later, we made a profit. We rolled it into the one we're in now.
That's kind of the normal process.
It was a normal process. It worked out perfectly. I know it's not everybody's scenario because like back in 08 or 09, the market just tanked and like houses were way less valuable than they even were a year earlier. So like you never know what's going to happen. But like for us, it worked that way. And I think majority of the time it can, right? But I'm just thinking about like, what are the banks going to do with the interest rates? You got a 30-year mortgage. We're used to what the rates are, right? They can bounce around because they're always changing. But if you stretch the payment and lower the payment, right, then could you maybe get a little higher interest rate if the bank wants to make more money? What are we going to do with that?
That's a good point. So if you are looking at a 30-year mortgage and we've got an interest rate, and then I've had clients like, Duke, what if I did a 25 or I did a 20? Going from a 30 to a 25, there's almost no change in the interest rate, right? It's the same. Going from a 30 to a 20, you're gonna usually get, these are always usuallys, right? You're usually going to get a little drop in your interest rate.
Okay.
Going from a 30 to a 15, I usually see a pretty significant drop. So as the time gets shorter and shorter and shorter, right, there's less and less risk to the lender. So I usually tell a client, if none of the stuff that I'm telling you makes sense, look at it from the lender's side, and it almost always makes sense. They're there to make money, right? They don't want to be in the real estate business. They want to be in the money lending business. So they don't want you to, they want to have to foreclose on your house and try to sell a house. So if you look at the lending side, a lot of the stuff makes a lot more sense. So if you went from a 30 to a 50, you're probably going to have a higher interest rate just because it's a longer amount of time. You're not paying down the loan as fast. It's a bigger risk to the lender that they're not going to recoup the money that they loaned you if something does happen, right?
Well, I mean, banking on somebody being able to sustain their finances for 30 years sounds risky enough. Now you want to go 50 years. I mean, there's a lot of things that change in people's lives in 30 years, let alone 50, right? So
yeah, I mean, life happens, right? You have kids, you've got, you buy a bigger house, you lose your job, you got to move to a different state because your job moves. I mean, there's a lot of things that can happen. So I've been thinking about this since we were talking about it.
Yeah.
The time frame is really, I mean, on average, you're the 5-ish to 8-ish to 7 years, somebody's in a house. So, you're going to have a lower payment. And I compared the 30 to the 50 just with my assumptions. And it's not considerably less. It's not like you're going to pay half the payment.
No,
you're not even going to pay like 30% off the payment, right?
Like if you had like a $4,000 payment, what were you're going to go 38?
Yeah, you're right.
Couple $100.
It's a couple $100.
Yeah.
But I mean that could matter. But nobody's going to stay in a 50-year mortgage, right? It's just probably not going to happen. I don't see that because rarely people stay in a 30-year mortgage.
Well, I mean, if they're bouncing out of their house every 5 to 8 years, then give them a 100-year mortgage. Who cares,
so
right? We'll just make it $1 a month. You can live in your house. I don't know,
But the kind of what I think people are thinking, if we've got a 50-year option, it's going to be half the payment, and I'm going to be able to get in the house. It's
20 years extra sounds like a shoot load of time, right?
It's not a silver bullet that's going to fix just the cost of buying a house right now.
Well, and what makes the industry work, right? What makes my job work, selling and buying houses, what makes lending work is we need turnover. Correct. We need people to get out of one house, buy another one. We need your kids to be able to get out of your house and buy their own damn house, right?
Yeah.
I'm sorry, all the parents out there, got kids living at home still. Like, we want them out, right? So, we want them to be able to afford a house. And truth be told, one of the biggest lessons I've ever learned when it comes to money, especially in real estate, is don't look at the payment. I don't even worry too much about interest rate. I look at what is my overall expenditure for buying this asset or buying this house, right? So if you go and keep in mind that this is just me talking out of my rear, right? Because all the scenarios are different, but I'm basically saying, like, if you're going to go buy a $500,000 house, doesn't matter what your interest rate is. At the end of every single payment you made for 30 years, right? No extra, no short, just you made every payment on time. You're probably spending $200,000-300,000 above that $500,000 price point. You didn't buy a $500,000 house. You paid for like a $700,000 or so.
Oh,
right?
Through the life of the loan.
Well, that's what I'm saying. Like, you didn't really just buy a $10 coffee. You bought a $30 coffee because you're taking 30 years to pay for it, right?
Yeah.
So if you're just extending that interest rate and your payment's 20 years, I mean, what are you going to pay the bank if you made every payment for 50 years? Like half the, I mean, it's just...
It's a shocking number. Like when I do a loan and you get the loan documents, there's a page that shows you at the end of this loan, this is how much you would have paid.
That's the one I focus on.
I mean, it's a huge number, right? If you're buying a $500,000 house, you're paying back like $800,000, $850,000,
which means you didn't buy a $500,000 house.
It's a lot, right? So I mean, the goal is to get to cash if you can as quickly as you can. In the meantime, you need to get. This is my plug for buying a house. But a lot of clients say, I'm going to wait and save up this year. And I'm like, okay, so if the house is going up 5% every year, you got a $500,000 house.
Right.
Can you save, $30,000 to catch up with that? Probably not. Most people can't save $30,000. The best thing you could do is get into the house, right, and start letting that value as it increases become your money.
Yeah.
And that may open the window a little wider at a 50, right? I wasn't convinced it was good or bad, but it's not, like I said, it's not this miracle loan that's going to just allow everybody that hasn't been able to get in the market to get in the market.
Well, and as a broker,
might work for some.
Yeah, it might work for some, right? But like as a broker, what concerns me is stagnation of the market.
Yeah.
I need people to go in and out of houses, and if the average is 5 to 8 years, I'm not selling one of my clients' houses. It's not like I bought you a house, helped you get into a home, and then next year I'm doing it again, right? So, like, on average, if it's 5 to 8 years, I feel like if the equity growth in a 50-year mortgage happens slower, we're going to start seeing 10, 12, 15-year lags on average. And if that happens, then our market goes stale.
Yeah.
Right? And
I can see that. I see your point.
And so like, is that going to slow down the actual real estate market, the lending market? I mean, I don't know. I mean, there's just a lot to it that I don't think anybody is giving out yet. Like the information is kind of unclear, right? Who's going to give those mortgages? Is it going to be a conventional 50-year? Would it be more government like FHA, VA? Like my thought process is it's probably going to be government-backed loans like an FHA or a VA. Maybe. I don't know.
I mean, you're right. You don't know where it's going to go. Most first-time home buyers are FHA.
Mm-hmm.
Just because
down payment.
FHA has a little higher down payment than a conventional loan. It's 3.5 instead of 3, which isn't a huge amount. The thing that really leans you towards the FHA on a first-time home buyer is one, there's going to be mortgage insurance on it, but mortgage insurance is fixed on an FHA. It has nothing to do with your credit score. Whereas a conventional loan, it's tied to your credit score. So if you're going to do an FHA loan and you got a 600 credit score and you got an 800, you're going to pay the same percentage for both of those. On a conventional, if you have an 800, you're going to pay like $50 a month. If you got a 600, you're going to pay $450 a month, right? That's the range of magnitude between those two. So normally first-time home buyers tend to have a little lower credit score. So that leans towards FHA. And then also FHA usually has a lower interest rate.
Right.
So those two things kind of tend to have the first-time home buyer going to the FHA.
Do they have any differences between the two loan types when it comes to your debt to income ratios? Or
they do.
No?
That's another good point. Is FHA you can go as high as 57% debt to income. On a conventional, you can only do 50. So lower credit scores, lower interest rates, higher purchase prices. That all kind of makes you want to go to the FHA. Once you've been in the home for 5-8 years and you've accrued some equity and you can sell that house and you got enough for 20% down, now you don't have any mortgage insurance. That's why almost everything goes to conventional after that. FHA, if you only put 3.5% down, always has mortgage insurance. It never goes away.
Right.
So if the 50-year went to, on the federal side, FHA, VA, USDA, I mean, that would make more sense for the first-time home buyer. I don't see anybody who's had 2 or 3 homes, and are sitting on 50%. They're not going to do a 50-year mortgage, right? Those people are coming to me and doing 15-year mortgages. They're doing a shorter mortgage because they're maybe getting ready to retire. Or
pay off before you die type loan.
Pay off before you die, right? They want.
I'm just saying, right?
Yeah,
You
I
know,
mean that's
I'm 60 years old. I don't think I got 30 years. Give me a 15-year. All right, I want to.
Most people are looking to have their home paid off by the time they retire. That's a good goal for anybody. Is
Yeah.
if you're going to retire at 60, 62, 65, wherever you're at, let's have that house payment gone. So that isn't something you got to try to
free up your cash.
Figure out how to do it.
I'm not as optimistic as some of the media has been on this whole 50-year mortgage thing, or at least the media that I've seen. I think it's going to cost people more money in the long run.
It will.
Personally,
it will.
I think it probably in some way, which I'm not really an expert on the loan side, but I feel like it might be a little riskier for a bank. So I feel like they're going to want to get more money. Right,
well,
so
that's going to be the higher interest rate, just like you said. If it's higher
so
risk, it's always a higher interest rate.
But there could be a chance it offsets any savings over the 20 years. I mean, as far as the lower payment, like to me, it just doesn't make sense. I just think maybe it's a shiny gimmick to spur some interest, but is it going to be effective or not?
Yeah,
I don't know.
You're probably right. It's like I said, it's not a silver bullet where all of a sudden this large group of people that can't get into a home, all of a sudden, payments are halved. You're not going to get a $3,000 payment out of 30 and get a $1,500 payment at 50. It's just
right, because if it did that, shit, I'd sign up for 8 of them, right?
Everybody's going to be doing that, right? So
I'd be like, I'll buy 8 houses on a 50-year mortgage and I'll die first. Who cares?
Yeah, it just is not probably not going to happen, right? There's no quick fix for what we're in right now.
That's unfortunate, but I understand the concept, the idea. Like other countries are already doing it. It's not a new thing. Just, like people are kind of sort of freaking out about it also. I mean, there's been some commentary about like, oh my God, it's so long or I'm going to die before you pay off a mortgage. I'll get a mortgage out of college and I'll be retired by the time I pay it off. I mean, I guess that's true if you made every single payment, but like you've said and I've said, like people aren't in the home that long. So do they really
for 50 years?
So like if you got a 30-year mortgage and you sell it in 8 years, you really only got an 8-year mortgage, right? Like what? I mean, think about that.
That's correct.
It's like a car. You can buy a $60,000 car, but if you only make 2 years worth of payments, you didn't pay $60,000 for that car. You basically rented it for a couple of years. And.
So here's another wrinkle I could throw at you. So if you do a 30-year mortgage and you make 1 extra payment a year, right, and do that every month, every year, you can knock about 5 years off of that loan. So you can make a 30 into a 25 just by making 1 extra payment. And the reason why that 1 extra payment goes so far goes back to your first payment. Let's just say it's 35% going to the principal to pay it off.
Right.
And the rest is going to interest.
Mm-hmm.
So we're really only knocking off 35% each payment. If you make 1 extra payment and it goes all to principal, that's like making 3 extra monthly payments.
Well, truth be told, the lenders front load their interest. They want to make their cut up front.
Correct, because they know somebody's going to get out of it in 8 years, right?
Yeah.
So if you did a 50, you don't have to pay it off as a 50. You could pay it off as a 30. And sometimes I'll have clients that go, I'd like to do a 20, but I'm not sure about the payment. And usually, like I said, there's not a huge difference in rate between a 30 and a 20. So I used to tell them, if it was my money, I would get a 30 and pay it off as a 20. And then if you have a bad month, or I don't know, your car breaks down, your transmission blows up, whatever it is, you need braces for your kids, you don't have to make that 20-year payment. You can make a 30-year payment.
I got you. So in other words,
it's going to be a lower payment,
right?
In case you have, something comes up, you pay it. You've got the 30-year payment, but you're paying as a 20-year. So you're paying more each month than you would to get it paid off in 20 years.
Right.
But if you have some sort of catastrophe, you don't have to make that $5,000 payment. You can make a $3,500 payment instead.
Right. No, that totally makes sense. Like it allows yourself above. So it's one of those things where you can't pay less to the bank because you had a bad month, but you can pay more if you had a good month.
That's exactly right.
And basically, you just don't want to screw yourself out of not being able to make the payment, because then you're just a whole nother, wreck your life, that sort of thing. You just don't want the bad stuff to happen.
You don't want to have a foreclosure. If you got a foreclosure on your credit, then pretty unlikely anybody's going to loan you any money in the near future, right?
Right.
That's one of the red flags.
And if they do, then you pay for it big time, right? Like interest rates are higher, stuff like that? Or?
Yeah, I mean, if you got a
Okay.
foreclosure, it's usually years before they'll allow you to get another. Any lender will do a loan for you, right?
Even the government-backed ones?
For foreclosures are usually big red flags that you want to shy away from that. So pay your bill. I mean, the people. I'll have people ask, how do I get my credit? Scores up. How do I get credit? I mean, there's no magic. Pay your bills and pay them on time.
Yeah.
There's no other there's no other special thing that you do is
live at home as long as you can.
Live
it's
at
cheaper.
home with mom and dad, right? Until they kick you out of the basement.
Just kidding. Yeah. Yeah.
But pay your bills and pay them on time. First time home buyers that maybe don't have credit. I'm getting a little off topic here. Go get a credit card. Get a credit card from a bank. Don't get a credit card from Lowe's or Home Depot, right? Go get a real credit card.
Yeah.
And start using it, right? So when my daughter turned 18, I got her credit card, and I think it had like a $3,000 limit, which shocked me for somebody who didn't have a job. That they gave a $3,000 credit limit to. I was telling her, like, 300. You're gonna be lucky if you're gonna get 300, honey. And she's like, yeah, it's like 3,000. I'm like, all right. So
Were you on the credit card?
No.
Oh,
it was. I mean,
seriously?
she was a student, but she had no job. She had no previous history of any sort of credit whatsoever. And they gave her $3,000. So.
Oh my gosh! See, back in my day, if you had no job, they just kicked you out of the store. They didn't even ask you.
Yeah. So I told her start getting gas, and we'll pay it off every month. And
you spend a couple $100 a month in gas. Just make sure you pay it off.
And you
every
pay it
month.
off. Do not carry. Right.
Don't carry the interest.
Yeah. Don't carry any
payment.
sort of credit load on it. Otherwise, then you're paying interest on it. You're digging yourself a hole. And it usually only takes a couple months. And
Sure.
I don't know, the last probably 3 or 4 times I had a client do that, it was a pretty strong score. Like in the 700s came out, like right out of the gates. It wasn't like a low score came out. It came out.
Well,
and that's probably not the case for everybody, but it's an easy way to get a credit score without getting yourself in debt.
Right.
The lender wants to see what you've done in the past. The only way that they know if you're going to pay them back is to look at what you've done in the past. Have you paid your bills in the past, or have you not paid?
It's like college. College is like a 4 to 5 year long-term commitment. Job employers basically just want to go, oh, you graduated college? I don't care what your degree's in. You can commit to something for 4 or 5 years.
Yeah, you stuck out something for 4 years.
You're likely to be a better employee, I guess, right? So, I mean, I graduated college. I wouldn't say I'm a better employee, but anyway, I'm just saying it doesn't work for everybody. But at the end of the day, it's your past that they're banking on to reflect your future.
Correct.
Right? Even though we can make mistakes and then fix them and then don't make them again. But how far back in the past are we looking? Like what's typical?
They can go up to 10 years, right? And look at what you've had on there. And some of the things on your credit are easy to fix, and some of them are hard to fix.
Mm-hmm.
The easy fixes are you've charged too much money and you're up close to the limit of a credit card. So one of the biggest levers for decreasing or increasing your credit score is credit card debt. If you've got
that debt to income thing, right?
No, this is debt that you carry based on the upper limit of your credit card. So say my daughter's got $3,000 on her credit card, and she's charged $2,999. That's going to have a huge impact on her credit score.
She's got no more room to lend.
She's got no more room. She's got no emergency money. The way they look at it is there's no emergency money. What if there's an emergency? There's no place to go, right? She's going to go to dad, right? But there's no place for her to go on her own credit. Now, if she keeps that level down at $1,000, which is the bottom third, she's got $2,000 she can spend on something, right? If for some reason the transmission or car blows up, she's got money to pay for that, and she can still make her house payment, right?
Okay.
So that's why the credit card debt is a big lever. As you get up past the bottom third of what your upper limit is, your credit score starts dropping down. So as you go back the other direction, it starts going back up. So if you've got high credit card debt, that's usually the first place you kind of want to start picking at the problem is getting those paid off.
And I would recommend you, I mean, you're the expert, but I would say if you're paying off things to get your credit up, then you're probably wanting to hit your higher interest rate stuff first, right?
So
I mean,
if you are,
because that'll cost you more money, right? The higher interest rate.
It'll cost you more money, but it kind of depends on what you're trying to do. So normally, if a client comes to me and says, "Hey, my credit scores are poor. I'm not sure. I need to work on that."
Mm-hmm.
I usually say, "Hey, give me an opportunity to take a look at it." Right? I'm not credit repair, but
Right.
I've seen enough credit, and I work with a credit repair company that let's take a peek and see what you need to pay off first.
Yeah.
So usually, they're trying to get an increase in the amount that they can purchase a home at. Right? So let's just say we get them approved at like $250, and it's like, nobody's buying anything for $250, right? You're not even. You're probably not even going to get a condo for $250. We need to get to $350.
Okay.
So it comes to your debt to income ratio. That limits what I can loan you. So once we get up to the certain ratio and we can't exceed it, that's the maximum amount I can loan you. So we need to either increase your income, which is almost impossible to do in short term, right? It can't all of a sudden give myself a $10 an hour raise and start making more money.
Right.
But I can decrease my debt. So
right, your output.
It's a debt to income ratio. So either you need to increase the denominator, right? And it's easier to pay off your debt. So normally I will look at what the debt load is versus the payment, and whichever one has a better ratio, I'll explain to them that's probably where I would start kind of pecking away at it. So if I owe, $1,000 and my minimum monthly payment is $250, and I own $5,000 and my minimum payment is $100, I'm going to pay off that lower one that has that higher minimum monthly payment. Oh, so your
higher minimum payment,
I don't care about the rate,
reflects on your debt to income?
Debt to income, right? Okay. So that's a way to decrease your debt.
But what if you're making all the minimum payments or something? Like, you're not late on any of your cards. Does it still brings you down or not up? Like,
so you're
paying the bills, right?
A late fee is a different thing, right? So if you have lates on your credit, there's no quick fix for that, right?
No,
it's time.
Just time.
If you got a 30, 60, or 90, you just need to wait, and it's usually a year or over a year before that kind of gets.
Oh, they're real quick to ding you.
They're still there, but it rockets down and it slowly climbs back up. So if you've got a late, the worst thing you do is to have a late, because it's really hard to recover from that in short term.
Yeah.
If you've got some high debt based on your credit limit, those are kind of the easy ones to peck away.
Because if you take the high limits and get them paid down, there's like a magic number or percentage of the amount of credit card debt to allowed credit. Is that what you're saying? Like,
so the credit,
like if somebody will give you, if you have 50,000 in credit and you're borrowing 40, you kind of want to be like less than that. You want more room.
You want to be in the bottom third.
Bottom third, okay. So 50 grand, you'd be like less than 20 grand.
So the way that the bureaus look at that is, how do I give this a score? How do I put a value to what you're doing with your finances?
Right.
And if you've got room to compensate for things that happen in life, which means you've got some room on your credit card where you can charge something on there, that means you're a stronger borrower than the person that has maxed everything out, because there's no place for them to go if there's a problem, right?
So these are all basically just measurements of risk assessment.
That's exactly
from a
what
lender.
It is. That's exactly what it is. They put a value to it.
You make yourself less of a risk, and the lender gives you more options, I guess, right? Or you have more power as a borrower, just kind of a thing. So
that's exactly, that's exactly right. Right, where the lenders are in the business of lending money, not repoing cars, foreclosing
homes. Well, it costs them
homes.
Money to do that,
right? I mean, they don't want to do that. They want to do that, right? So that is, and that goes, kind of plays into another area for home buyers of mortgage insurance, right? So why am I paying mortgage insurance?
Well, I mean, what does it cover for the borrower?
It doesn't.
It's like a lender's insurance, right?
It doesn't. I mean, that's exactly right. So a lot of clients are like, well, what am I getting insured? You aren't getting anything insured. Your lender's getting insured.
But you're paying for the insurance.
You're paying a third party. I said, and I mean, it's good or bad. It's genius. A third party stepped in and said, hey, lenders are, if I lend you 80% of the value of the house, it's more than likely if I have to repossess your house, I'm going to get all my money back.
Sure.
Right, and I can get it back quickly because I can drop the price of the house. I can do a lot of things to get this house gone and get back to lending money like I want.
Because they're not cared about the equity; they care about their initial investment as a lender. They just want their $500,000 back.
They want their $500,000 back. They don't care about the house
or
right?
whatever.
They're not property managers. They're not real estate agents. They're lenders.
But it still takes them like what, a year to get to that point? I mean, it's not like when they foreclose, it's a week.
I think it depends.
It takes time.
If you want to, so. The last house that I bought here in Washington, it was a short sale, and the people that I bought it from hadn't made a payment in 5 years. So,
my God! What?
If you want to, they got a lawyer and they were fighting. It was kind of during that time when they were doing the robo signing and stuff, and so documents got lost. So if you want
mine too. It's in the mail.
If you want if you want to dig in, right, and fight the man. It could take a long time, right? If you want to turn around and say, hey,
if they had money for a lawyer, why not just pay the damn mortgage? Come on.
But no, they hung out and fought it for a long time. So the foreclosure length, I mean, I really got no input on it. I could tell you how long that takes, right? Maybe it takes 6 months. 6 months to 5 years, let's say that, based on what I've seen. But mortgage insurance is, like you said, it's insurance for the lender, right? Some genius came up and said, hey, Mr. and Mrs. Lender, how about if you loan money, but the person only has to put 3% down, and then we'll insure the rest down to that 80% loan to value that you like, but we'll charge the person that's buying the house totally separate. And we'll provide mortgage insurance to you, lender, that if they default on the loan, we'll make you whole. And the lender's like, perfect, right? We're back to our 20% down,
so
80%.
In this case, the lender basically, I don't want to say zero, but they go from all the risk to very little when they have mortgage insurance.
That's why they do it.
But the consumer's the one paying for that insurance.
Correct.
And I've had clients where the lender ended up later telling them that they had to have mortgage insurance, and then it pushed them over the whatever budget allotment that the lender would lend them. Like
the debt to income.
The payments were close, and then that extra X amount of hundreds of dollars, it pushed them over, and now we're like, oh, you can only buy this much house now.
Correct.
And it can really screw things up, right? So
it's the house payment. When you're looking at the debt to income, we look at all. I just had this question yesterday. The guy's like, well, what do you look for debt, right? What about my phone? What about this? My power bill? I'm like, no, we don't look at anything like that. We look at credit cards, obviously. We look at student loans. We look at like car payments, those sorts of things. Power, all the other stuff that's like associated with your house just to keep it running. We don't care about, right? If you've got child support, those sorts of things, we care about. And then we take that debt, which is the minimum monthly payments, and then we include the house payment in that too. That's going to be your true debt after you've purchased the house. That's the debt part.
Right.
And the income is your gross income. So whatever you gross is just, it's the denominator. Whatever is on the bottom is.
Well, and I do appreciate that lenders will give me money based on my gross and not my actual.
Yeah,
because
your net, right? Yeah,
like my net's a whole hell of a lot less than my gross.
That's why you only do like a 50% debt to income.
Right.
We're taking into account, you got taxes you got to pay, you got your power bill, you got all this other stuff.
Yeah.
Somebody asked that, well, how do they know? I'm like, well, we're only allowing you half of your income, on a conventional. Because there is all this other stuff that you got to pay.
So basically, groceries. If you make $100,000 a year, you're really lending on if you make 50-ish. I mean, that's kind of
that's correct.
I guess that's correct. Yeah, it just sounds that way.
Yeah, if you gross 100, we're going to use 50% of that. So we're going to use $50,000 and compare that to your monthly debt. That's what we're going to do.
So given that the average American doesn't even earn $100,000 gross. I can probably imagine why it's a little hard to get into a house now.
That is it. I mean, if you're
cutting my gross in half, what if I make $60,000? I make 30?
If you're a single person and you're just getting started, I mean, it is. I don't know how you buy a house. To be honest with you. right? You're starting out and you're making, I don't know, $50,000-$60,000 a year.
Well, that's not what you're basing my stuff on. You're basing it on half of that.
You can only have debt to half of it. So if you're making 60,
but the mortgage payment includes in that debt, right?
Correct. You can't. So if you're making 60, your debt can't add up more than the $30,000 for payments, right?
Yeah. Okay.
For a year.
Okay, so that might explain a little bit about why it's hard to get into a house.
So yeah, if you make $3,000, if your $3,000 payment, right, that's $36,000 out of your 60, right, that we're going to take out.
Well, in theory.
Yeah.
But don't forget, I probably have a car payment or
most
student
people got
debt
a car payment. Most people got student loans.
Or I got those credit cards on student campus that I forgot is real money I have to pay back.
Yeah. Yeah.
I mean,
a normal client has, one or two car payments. They got one or two credit cards. Maybe 20% of the people have got some sort of student loan
right.
that they're paying as well.
But basically, it's really easy to credit yourself right out of being able to even buy a house.
Oh yeah,
if you've got half your income to be used, I mean it's kind of
there's train wrecks I've seen where they've if you got 20 credit cards, they're all maxed out. You're probably not going to get a house. It's too much of a risk to the lender.
So after all of this, I go back to the 50-year thing. They say they're introducing it possibly to make housing more affordable for people. But if you're just going to be paying interest for a longer period of time, or I can't imagine they're going to make some special arrangement for an extra 20 years. Like, I just think it's going to end up not really having any effect. I
think you're right. I don't think the impact that it has is going to be minimal. Like I said, it's not a silver bolt. Like all of a sudden, houses are affordable and you can get into it. It's like when you used to get when you bought a car, they had a 3-year and then they went to a 4, a 5, and I thought somebody said they even have a 7-year.
Dude, I've heard they go to 9 on certain cars.
Right?
Like, I mean,
it chips away at your payment, but like you said,
well, but you're paying more in the long run.
A ton more.
Yeah.
If you look at the final value that you're paying back, 30 versus even 20 versus 30 is a huge difference.
Well, now
30 versus 50 is a monumental difference.
I will say though, just for clarification, car payments are a different amortization rate. Like, mortgages are amortized and the interest is
it's not simple interest rate.
Yeah, it's not simple. It's compound, right?
It's called compounding.
So like you buy a car at 1.9%, you're basically going to say, I paid $50K. What's 1.9% of that? That's what the lender makes for giving you the money. But on a mortgage, it's not simple. You get 5%. It's like compounded daily, month. I don't know.
It's compounding interest.
If it was simple interest, that'd be great.
Yeah.
So maybe maybe we should actually change the amortization or the rates for mortgages. Make them simple loans. That would that not make the entry barrier less?
That would be,
right?
But you probably wouldn't have a whole lot of lenders that would do that because you're not going to make very much money doing that.
Well, right,
they
but
probably would
if
take their
people
money
could afford
and
things, wouldn't they be able to make money because you could pay it?
I mean, this is I'm not an economics expert, but the reason lenders lend on houses is because they're making money, right?
But they lend on cars and they don't make the same kind of money, but they make money.
They make money, and I think if you were to go to a simple, a lot of lenders probably would take their money and go some other place because they could make more by investing their money some other place.
Well, I mean, I
think my opinion on the 50 is it's probably not going to happen in the near future.
You don't think so?
If you want to get into a house, let's do a down payment assistance loan, which you can do right now.
Well, that's true, and I did want to mention that, but when you go FHA, there's Washington programs or something that help people get into homes if you meet certain things, right?
Correct, and it's a pretty low bar. I mean, it's pretty easy to get in there.
It's Washington Bond?
Washington State Housing Finance Commission. The slang term is WA bond.
Okay,
so what they call it.
For people who might tune into this, where, like, you're a first-time home buyer, you've got a job, you've got your finances in line, you can buy a house, they go to somebody like you and they're like, hey, here's me, can I buy a house? And when or why would you direct somebody or advise somebody, I should say, to go like with this down payment? Like, what are the scenarios that make sense for that?
Why would they use that loan program? It's almost always they don't have enough money to put down on a house, right? I've got X dollars and I want to go buy a house. I've got low debt. I've got a decent income, but I just haven't saved enough money to get into a house. So the down payment assistance program, and I've taught class on this for the last 5 years. They used to have limits on credit scores. They got rid of that. And they just changed. You couldn't make more than $180,000, and they just changed it, I think, to $210,000. So pretty high barrier on the income side, right? Like I'm saying, it's a low.
First-time home buyers making that kind of money?
Usually, if you're making that, I don't know if I've ever come across where somebody that was wanting
you got to
to
have a down payment if you're making that kind of money. Damn.
Yeah. So I mean, normally people that are making like $80,000 to $100,000 are kind of using that program because it's easier to get into a house as far as cash out of pocket. So the way the program works, you can do conventional FHA, USDA, VA, you can do all the loans, but it's really kind of geared more towards an FHA loan. They've got better rates on the FHA loan side. And they will loan you anywhere from 3 to 5% of the loan amount that you can use towards the down payment. So it's a second mortgage. So your first mortgage is going to buy the house. Your second mortgage, which is the down payment assistance, is going to pay for the down payment portion, which the client has to bring out of their pocket, right? So if you're buying a house and you've got the down payment and then you got closing costs and fees, which are just the cost to do the loan.
Right.
Seller can pay for closing costs and fees. Nobody else can pay for that down payment. That's your skin in the game, right? That the lender says you have to have something in this, or else you've got no risk there. You need to take some of that risk when you're buying a house. So the down payment portion has to come from you. So you can get a second mortgage to do that, and that's what the down payment assistance does. Is it has a second mortgage. They don't charge any interest on it, and you do not have to make a payment for one portion of that program.
That's what I was going to say.
Which is the portion that I do the most. It just it's I call it free money because you have to pay it back, but they're not charging you interest on it, and you're not charging any payment.
So your payment's going to be based on the purchase price of the house. The program
does not add anything
covers
to your
down payment.
Yep.
And you don't pay any of that now. Correct. When do you pay? It's got to be paid, right?
You pay it. There's several times when you got to pay it. If you sell the house, you have to pay it off. If you refinance the house, you have to pay it off. Which is like
a sale.
Which is like, if you refinance, you're paying off your first mortgage.
Which is happening when you sell the house.
And getting the next mortgage, right? Or if you stay in the house for the life of the loan. So it's a 30-year mortgage. If you stay, it's really, the second is a balloon payment. People get scared when they hear balloon payment. But if you stay in the house for 30 years and make your last payment on it, they're going to say you need to pay back all of that second mortgage right now. But we go back to people staying in houses 5 to 8 years. You never, I shouldn't say never. It's pretty darn rare anybody's going to do a 30-year mortgage without doing some sort of refinance or moving, right? So that's I tell people, don't be afraid that's a balloon payment. You're going to pay it off when you sell the house or refinance. So those are the two times you're going to pay that house off. You don't or pay that second mortgage off. You don't have to worry about it usually before that because you're probably not going to go to a 30-year.
Right. So if you buy a house on the program and then 10 years later you sell it, you're basically banking that you've gained enough equity between growth and pay down that, I don't know, 20, 30,000 maybe of down payment. You've been holding on to that the whole time. It just kind of like somewhere it's noted that you owe this money.
Yeah, it's usually 15 to 20 grand.
So they'll take it out of the equity during the sale.
Correct.
So you might,
there's always a downside, right?
Yeah,
like you asked on the 50 year.
You got to pay the money.
What's the con, right?
Yeah.
The con is when you sell the house, you're not going to get as much money back. But the down payment is something that you should have paid anyway, and you have to pay if you would have bought the house without the program.
Just pay now or pay later.
Pay now
right?
or pay later is exactly what you're
But there's
looking
no
at.
interest on it. So
There's
it's not
no
like you borrow 15, you're not going to pay him
Right.
25. It's 15 to 15.
There are other programs. I shouldn't. So within the Washington Housing Finance Program, there's a whole bunch of other sub programs.
Okay.
Just the Home Advantage, which is kind of the main one. That's the one we're talking about right here.
Right.
There are House Key and some other ones where you do have a simple interest that you have to pay.
Oh, okay.
So, but those are I don't do those very often because it's a very special case to get that person qualified. So just in general, we're talking about the Home Advantage.
Yeah.
The con is when you sell your house, right? You're going to have to pay what you borrowed before.
Right.
The other con is the interest rate is higher. If we just go do a straight FHA loan, no down payment assistance, you're going to pay a lower interest rate than if we do the down payment assistance.
So there's
no free lunch, right?
So there is a bit of an increase then in the rate if you
there
do
is, depending
the down
on
payment
yeah,
program.
And as you borrow more on the down payment assistance, if you go from 3 to 4 to 5%, that interest rate gets higher and higher too. So as you're using more of the down payment assistance, bigger risk, they're going to charge you a higher interest rate. And
so would there be ever a problem in then qualifying to use the assistance program? If it raises your rate, that raises your monthly.
correct.
Would there be ever
Yes, you can get in scenarios where, hey, I can get you qualified if you borrow, a 3% down payment assistance for the second.
But you do 5
versus
now
a 5. Now, right?
Too much money.
Your payment has gone up. We've crossed that threshold. And usually, if I'm doing the down payment assistance with first-time home buyers, we are right at the threshold. We are.
We're first-time home buyer. We're younger. We make less money. We don't have that great. And
I usually explain them the affordability is all your responsibility. You need to figure out. We'll loan you usually more money than you want to borrow. You need to figure out if you want. I mean, there are things you want to do in your life, right? If you're a skier or mountain biker or camper or something like that, you need to save some money so that you can do those things that you like to do. But I also say, if you're young and kind of starting in your career, a reach payment's not too bad of an idea.
Right.
You're going to get advancements. You're going to move through your career. You're going to be making more money just in general because that's normally what happens, right? When you're starting out early in your career. So a lot of times people are like, well, my parents only had like a $700 payment. I'm like, well, when they got that $700 payment, right? They're like, holy crap, that is a huge amount of money, right?
Yeah.
That's a big payment. And then 20 years later, it's like that. It's a ridiculous payment.
Well,
So
I mean,
keep that in mind too, right?
Let's be honest. My mom bought a house. It was $63,000. She had 14% interest rate.
Yeah.
Right. You give me a 14% interest rate on $500,000 now for the same house.
Oh, God.
Like, dude, you can't afford to. You're done. You can't do anything. So, I hear that a lot too, right?
Yeah.
I do. I hear it a lot. It's like, oh, well, he's been in this house for so long. That's why he can afford it. Well, it's going to be the same for you. You buy a house now at these prices, at these rates. If you go to your grandchildren, they're going to be, well, of course you could afford it because look at when you bought your house.
It was $63,000.
Yeah,
right?
It was only $500,000. Now that house is $2 million.
Yeah,
it's like
giving it away.
So it's all relative based on our scenarios, where we live, what era of time you bought your house, right? So I tell people, don't try to ride the wave. Don't bank on the market. Don't wait for a collapse. If you're ready, pull the trigger. There's people like you and I out there that genuinely care and want to help you.
Yeah.
And we'll do everything we can to steer you in the right direction. Not steer you, but like guide you in the right direction, right? Like
give you options.
Steering's a negative word for those people who don't know. But
no steering.
No steering. I just meant like we're here to point you in the right direction as we see it, and if it works for you, then great.
Yeah.
But if you're ready to buy, do so. If you're not, you can still come see people like Duke and get suggestions on how to become ready.
That's a great point.
Don't wait.
Don't
come
wait,
see him now.
Right?
He can help you.
Sometimes if there are credit issues, we can start addressing them right now versus you wait 6 months and then you find a house that you love.
Yeah.
And now we got a 2-month issue we got to deal with to try to get this figured out.
Right. Right.
It doesn't cost anything to talk to me or Collier. It's
Right.
all free. We don't get paid until we sell a house and
Right.
close a loan. There's no out-of-pocket cost to just
Right.
start poking around and getting the temperature of what you think you can buy.
Well, and right off the bat too, like if I meet somebody and they say, yeah, I'm just starting to look for a house, I ask them, you know, like, do you own one now and you're going to sell and buy? If they say, no, we're first-time home buyers, never owned a house, the very first thing I ask them, have you figured out your lending?
Yeah.
Are you lending?
Yeah.
And then when they say yes, I say, have you figured out your lending? Because I don't want to go show you houses and then have a lender tell you, well, those are out of your price range.
Yeah.
I'd rather you go to a lender, find out what your scenario looks like, then you come tell me what your budget is. And then I look for the appropriate housing to not only fit your budget, but then also I got to fit all your dreams, right? So, you know, I gotta have your 5-car garage, but it's only $400,000. So, but it's fine. We can figure it out, right? It's just
you get 5 of your top 10 wish lists. You're probably doing pretty good on a first-time house.
Yeah, exactly.
I think that you know, people have got questions or comments or anything like that. You know, both of us would love to give you a hand with whatever you're going through right now and see if we can't get you pre-approved or at least a plan that we can see what you can do right now. So there's usually 2 or 3 options that we can look at. Most of the time, one kind of lends itself towards what makes the most sense. But like Collier said, there's no reason to wait.
If you're ready, you're ready.
You're ready, and we can look at it. And if we got a 1-year plan, everybody can buy a house. It's just when are you going to buy a house, right? Is it going to be 6 months from now, a year from now, or a month from now?
Well, thanks for coming.
Yeah, thanks for inviting me. I appreciate it.
Problem.
Until next time, right?
Absolutely.